Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we are diving into one of the most important yet often misunderstood indicators in global financial markets: oil prices. Now, when most people think about oil, they usually think about petrol prices at the pump, heating costs, or maybe geopolitical tensions in the Middle East. But for traders, investors, economists, and policymakers, oil represents something much bigger. Oil is one of the clearest real-time signals of what is happening beneath the surface of the global economy. In today's episode, we are going to explore the oil price macro impact in detail and explain why many professionals refer to energy as a macro barometer for global growth. We'll break down how oil prices connect to inflation, manufacturing, transportation, consumer demand, central bank policy, geopolitics, and even stock market behavior. We'll also look at historical examples where oil prices signaled major turning points in the global economy long before official economic data confirmed what was happening. So whether you're a trader, investor, or simply trying to understand how global markets work, this episode will help you see why crude oil remains one of the most important indicators in modern macroeconomics. Let's get started. One of the first things to understand is that oil is deeply embedded in the global economy. Despite the rapid growth of renewable energy and electric vehicles, the world still relies heavily on crude oil and refined petroleum products. Transportation systems run on fuel. Cargo ships moving goods across oceans require massive quantities of energy. Airlines depend on jet fuel. Trucks transporting food and products across countries rely on diesel. Manufacturing plants consume energy constantly, and petrochemicals derived from oil are used in plastics, fertilizers, industrial materials, and thousands of everyday products. In simple terms, economic growth requires energy. And because oil remains one of the primary global energy sources, rising demand for oil often reflects rising economic activity. This is why traders monitor oil prices so closely. When economies are expanding, consumers tend to travel more, businesses produce more goods, factories increase output, and international trade accelerates. All of those activities increase energy demand. As demand rises, oil prices often move higher. This relationship has existed for decades and remains one of the core foundations of macroeconomic analysis. That's why the phrase energy as a macro barometer is so important. Oil doesn't just reflect what is happening now. It often signals what could happen next. And this is where things become particularly interesting for financial markets. Official economic data is often delayed. GDP reports are released quarterly. Employment data comes out monthly. Manufacturing surveys provide snapshots, but they still lag behind real-time economic activity. Oil markets, however, react instantly. Crude oil futures trade continuously, and prices adjust based on expectations about future supply and demand. If institutional investors believe global growth is accelerating, oil prices may rise before economic data confirms stronger activity. Likewise, if traders begin expecting economic weakness or recession risks, oil prices often decline before official reports show deteriorating growth. This forward-looking behavior makes oil one of the most valuable leading indicators in global finance. Let's look at some historical examples because this relationship becomes very clear during major economic turning points. One of the most significant examples was the 2008 global financial crisis. Before the crisis fully unfolded, oil prices surged dramatically as economic growth remained strong worldwide. Emerging economies, particularly China, were expanding rapidly. Manufacturing output was booming, global trade volumes were rising, and energy demand climbed sharply. Oil prices eventually reached nearly $147 per barrel in mid-2008. But then financial markets began collapsing. Credit markets froze. Consumer spending weakened. Businesses cut investment. International trade slowed rapidly. Factories reduced production, and global demand started falling. Oil prices collapsed shortly afterward because the global economy was suddenly consuming far less energy. The decline in oil prices became one of the clearest signals that economic activity was deteriorating worldwide. Then we saw something even more dramatic during the COVID-19 pandemic in 2020. This was perhaps the clearest modern example of oil acting as a macroeconomic barometer. Global lockdowns halted travel almost overnight. Airlines grounded fleets. Millions of people stopped commuting. Manufacturing slowed dramatically, and supply chains were disrupted across nearly every major economy. Oil demand collapsed at unprecedented speed. In April 2020, U.S. oil futures briefly traded below zero. Now think about how extraordinary that was. Traders were literally paying buyers to take oil off their hands because demand had vanished so quickly and storage facilities were filling up. That event shocked financial markets because it revealed how tightly global economic activity is connected to energy consumption. When economies stop moving, oil demand disappears. But then came the recovery phase. As economies reopened in 2021 and 2022, consumers began traveling again. Supply chains restarted. Industrial production accelerated, and global demand surged. Oil prices rebounded sharply. At the same time, inflation pressures started building across the global economy. And this brings us to another critical part of the oil price macro impact: inflation. Oil prices affect inflation because energy costs influence almost everything. When oil prices rise, transportation becomes more expensive, shipping costs increase, manufacturing expenses rise, airlines pay more for fuel, food distribution costs increase because trucks transporting products require diesel fuel. Eventually, businesses pass many of those costs on to consumers. This creates broader inflation throughout the economy. So when traders monitor oil markets, they are not only watching energy demand, they are also watching potential inflation pressures. And inflation matters enormously because central banks respond to inflation by adjusting interest rates. This creates a powerful economic cycle. Economic growth strengthens. Energy demand rises. Oil prices move higher. Inflation pressures increase. Central banks raise interest rates to cool the economy. Eventually, tighter financial conditions slow growth. This cycle plays out repeatedly throughout economic history. That's why professional traders watch oil alongside inflation data, bond yields, and central bank policy announcements. Oil prices influence far more than energy stocks. They affect currencies, equities, bonds, commodities, consumer confidence, and even housing markets. Now, it's also important to understand that not all oil price increases are positive for the economy. There's a major difference between rising oil prices caused by strong economic demand and rising prices caused by supply disruptions. When oil rises because factories are producing more, consumers are spending more, and global trade is expanding, that generally reflects healthy economic growth. But when prices rise because of geopolitical conflict or supply shortages, the economic consequences can be much more negative. This is where geopolitics becomes extremely important. Oil-producing regions are often vulnerable to political instability, military conflict, sanctions, and supply disruptions. Markets closely monitor OPEC plus production decisions, tensions in the Middle East, shipping routes like the Strait of Hormuz, and sanctions on major exporters. Even the threat of disruption can move oil prices sharply higher because traders immediately begin pricing in potential supply shortages. And when energy prices rise too quickly because of geopolitical shocks, businesses and consumers often suffer. Higher transportation costs reduce corporate profit margins. Consumers spend more on fuel and less on discretionary goods. Inflation rises, and central banks may tighten monetary policy more aggressively. In these situations, high oil prices can actually weaken economic growth instead of signaling expansion. This distinction is incredibly important for traders trying to interpret market conditions accurately. Now let's shift toward the future because the global energy landscape is gradually evolving. Renewable energy adoption is increasing. Electric vehicles are becoming more common. Governments are investing heavily in cleaner technologies and energy efficiency. But despite this transition, oil remains deeply important to the global economy. Heavy industry, aviation, shipping, petrochemicals, and large portions of global transportation infrastructure still rely heavily on fossil fuels. At the same time, emerging economies continue driving energy demand growth. Countries like India, Indonesia, and several Southeast Asian economies are urbanizing rapidly. Infrastructure development continues expanding, industrial output is increasing, and growing middle-class populations are consuming more energy. So while developed economies may gradually reduce oil dependence over time, global demand remains significant. This creates a fascinating transition period where traditional energy markets and renewable energy systems are evolving simultaneously. And for traders, this means energy markets will likely remain central to macroeconomic analysis for many years to come. Understanding energy as a macro barometer is not just useful for commodity traders. It matters for equity investors, forex traders, bond market participants, and anyone analyzing global financial conditions. Oil prices provide insight into industrial activity, transportation demand, inflation trends, geopolitical risk, and consumer behavior all at once. That's why professional investors continue monitoring crude oil so closely. And if you want to deepen your understanding of macroeconomics, trading, investing, and financial markets, make sure you check out the beginner-friendly Crystal Ball Markets podcast at iss.com/podcast/crystalballmarkets. It's an excellent resource for traders and investors looking to improve their understanding of financial markets and global macro trends. And if you're looking for a world-class, cutting-edge, user-friendly trading platform, visit crystalballmarkets.com/platform and explore the tools and market access available for modern traders navigating today's fast-moving financial environment. That's all for today's episode of Financial Market Insights for Traders. I'm Sophia, and thank you for listening. Until next time, stay informed, stay disciplined, and keep learning.